Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Adrianne Yamaki, founder and financial advisor at Strategic Wealth Capital. She joins me to discuss overlooked tax deductions. Adrianne, it's great to see you as always. Welcome back to Trade Talks.
Thanks, Jill. Good to be here.
All right, everyone's favorite time of year. We're coming into April 15th. It's tax season. And I feel like we're
Yes.
starting to hear a lot about overlooked tax deductions. How come we don't know about these things?
I was thinking about this. I was talking to a couple of CPA friends, and because the tax season is so concentrated, I mean, statements and 1099s don't come out till January, and then CPAs are so overloaded with processing returns and deductions and gathering everything. I think a lot of people don't have a chance to really sit down with their CPAs first quarter and say, okay, what are the new deductions that we might be eligible for because things have changed in our circumstances last year or the tax law. So it's something that I think advisors are lucky to be able to have a broader view of.
So let's go through a couple of these tax deductions here. What about business owners and home office tax deductions? What should we know here?
So first of all, if one is self-employed, then one is eligible to potentially take this deduction. So for W-2 clients, so typical work from home, unfortunately, for the most part, they're not able to take these deductions. But if you're self-employed, if you have consulting income, gig income, business owners, there are a number of fairly generous home deductions one can take that there are a couple of different ways to calculate it. One is simplified certain square footage you can deduct from tax income, from your earned income. The other is on a square footage basis. And it's very, very broad. It includes maintenance, repair, internet. And this is something that I think at least a lot of our clients who have consulting income didn't realize they could do because most of the people they know who've worked from home don't qualify for this type of deduction. But it can be a fairly rich tax deduction if one's willing to take the time to tally these things up.
So I get a W-2 from work, but I do work from my house 3 days a week. Am I eligible for those deductions?
Do you have consulting income?
No, if you're like, I work for Nasdaq, work 2 days in the office, 3 days from home. Are you eligible if you have a hybrid role like that, or is it specific only to homeowners and 1099 workers?
So it really depends on, so if one is a W-2 and that's the only source of income, then unfortunately you're not eligible to take the home deduction. What a lot of my W-2 clients are doing is asking employers, can you pay for internet? Can you pay for the screen? Can you pay for what I need to be able to use in a home office? But if you do have 1099 income, even if you have some, for example, if you had consulting income, that can be eligible. As long as you have self-employed income, you're eligible to take potentially eligible to take the home office deduction. There's some stipulations around it has to be a space used primarily for work, and a number of other, you have to essentially qualify for it, but it can make meaningful difference in your taxes.
What about taking advantage of 529 in state-specific plans?
Yes. So over time, I've just seen 529s become so much more rich in terms of choices. So we just saw now there's less risk of being overfunded because you can roll it over time into a Roth if a child doesn't use it for college. But one thing, while 529s are still growing, that I think a lot of individuals don't take advantage of is state-specific deductions. So in New York, a married couple can contribute $10,000, and if you're in one of the higher brackets, that's easily $1,000 of savings every year. But what I also point out to clients is it's $1,000 of tax savings, but that's really $2,000 of income because the tax savings is dollar for dollar. And clients spend a lot of time focusing on their earnings and focusing a little bit less so on the expenses. They see that as having a choice. And I think a lot of the clients see it as a tax filing it's what it is. It's not a particularly exhilarating exercise. Taxes due are taxes due. But in reality, there are a lot of tactics and strategies. If situations change, tax laws change, and it is absolutely worth spending the time to make sure you're leveraging and taking advantage of all the deductions and credits that you may be eligible for, regardless of your income level.
Tell me about parental Roth conversions.
So this is something that we've been doing selectively. So this is the kind of the sandwich generation. A lot of our clients are in their, for example, mid-50s, and their parents who tend to be of an age where they are extremely good savers, often have very large IRAs, large 401ks, which they roll over and which they're not going to deplete during their lives. The trouble with inheriting an IRA, a pre-tax IRA, imagine if you're 55, is that you may be you're in your highest earning years, potentially. You may be in a very high tax state. And because of the IRA rules where you don't have a stretch IRA option anymore, you have 10 years to withdraw, which may coincide with your highest earning years in your career, meaning you'll lose potentially, if you're in the top brackets, half to taxes. So what we've done is for our multi-generational families, when we work with the grandparents, the parents, and the kids, is we look at, okay, so the grandparents have a huge IRA, how much is likely to be spent during their lifetimes and how much is going to go to our clients, their adult children. And from that, we can see this is what the tax liability is going to be when the children inherit it. And if we selectively can sneak out some money, 25,000, 50,000, not so much to bump the parents into a higher bracket, but enough so that it's in a Roth. If the adult children then receive the Roth, it's tax-free for their whole lives. They still have the 10 years to withdraw, but that's a meaningful difference because their parents generally at a lower tax bracket. And the nice thing is it stays in the parent's name. So if they do end up needing it, they never lose control of it. It can be a more complicated, on our side, analytical process, but it's it's really advantageous if the family is trying to lower the estate taxes and the income taxes for the whole family.
All right. Appreciate the insight as always, Adrianne. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.